The market has been absolutely wild recently. It's gone down because of the war, and now it's back up even though the war isn't technically over. And in our last episode, we talked about how to sell puts or trade options in a down market. And so today I'm going to tell you guys how well this portfolio has done in that downswing as well as the subsequent recovery. Just to demonstrate how powerful it can be if you stick to a simple but consistent strategy that allowed me to retire after 10 years in corporate. So let's first take a look at our portfolio. And this portfolio started around a year ago with around $80,000, and now we're sitting at $141,000 by predominantly just selling puts and getting assigned when they need to be assigned. And if you just dive a little deeper, right, you can see at the bottom of the war, we were sitting close to $120K. And right now we're at $141,000, resulting in our account being at all-time highs. Now, the crazy part is, if you look at our year-to-date performance, we are actually still significantly outperforming the S&P 500. 4.22% compared to a 10.55%, and this doesn't even include today, where we're up close to 3%. The question here is, how do we go about doing this? And what we did during this downswing matters a lot more to our overall profitability than what we did during this upswing. So let's talk about it. So we're gonna first head on over to Premium Insights to take a look at how well our options selling performance has done year to date. And you can see year to date, we're up close to $5,376. Otherwise, close to a 7.3% return on our invested capital, which is in line with our 1.5% monthly yield each and every single month. And it's only been around 4 months. Now, if you just look at the last 30 days, right, which is from the bottom of the market to the top of the market, we are up close to $2,100 in realized profits. And we're still not accounting for the $1,700 of open premium on the options that haven't closed. So if you take a look at our income or our cash flow, you can see that in March, when the market went down, we collected a lot of money during that 1 month, close to $2,500. And as April continued to go up, we reverted back to the mean, which is close to $1,200 a month, right in line with our average. And to take this one step further, our overall yield, we're targeting it at 1.5 to 2.5% monthly yield. So you can see on that 1 month, we're at 2.3% yield. And as the market has gone to all-time highs, we're now back to 1.1%. This should be technically a little higher because we have covered calls that we're selling at 0.2 to 0.5%. And if you just take a look at the last 3 months, you can see we've collected $4,500 in cash secured puts and only $581 in covered calls, which is these two options way down here. So now that we understand how the performance has done, let's talk a little bit about how we got these gains. So first thing first, I want you guys to understand the way we make money selling options is when we harvest what we call volatility risk premium. And that is a fancy way of saying when implied volatility is greater than realized volatility. So we like to track this using an index called VIX, which is an overall volatility index. And we talked about this in our masterclass, but when VIX is low, we actually do not want to be selling a lot of options. Why? Because when VIX ultimately goes up, even if your stock does not move, your option prices will go up and we will end up losing money. Vice versa is when VIX is high, there is a strong likelihood that eventually VIX will regress to the norm. Beginning the year, VIX is very, very low. The war started, VIX spiked around 30, 31, and now it's back down to 18. Same thing happened during these, tariff announcements. Same thing with Liberation Day here, right? VIX will spike and ultimately always come back down. It's just a matter of when, not if. And so when VIX spikes, our option prices go up, right? And so when we sell our options, we collect more money. If we head back to Premium Insights, you can see during really calm months, I'm actually not collecting too much money, right? I'm collecting around $1,000 a month. But when VIX spikes, I can collect a lot more and I can deploy my capital much more aggressively. This time around, when the market fell and VIX spiked, I started selling cash secured puts on Microsoft. And you can see just from Microsoft right now, I've collected a total of $2,075, around a 5.3% return. I started at 360. I immediately rolled that up to 365 because I realized I wasn't close enough to the money. And I rolled that up to 370, 375, 390, right? You can see all that money combined, all within 3 weeks, was a 5% return. Microsoft has fallen all the way down to like 360. And so when it got close to 360 or all the way down, when VIX was high and Microsoft was low, this is a really good opportunity for us to come in and try and acquire great companies at great prices. And so what do? You go and sell cash secured puts right at the money or slightly below the money, because the downside risk is actually a lot less than what it used to be. And so if it continues to go down, there is a higher likelihood that Microsoft may recover. And on top of that, when VIX is high, even if Microsoft doesn't move, right, and the overall market returns back to normal, you will win on your option. And in this case, VIX dropped and Microsoft went up. Therefore, I'm able to collect a lot of money very, very quickly. Which gets us to the second point. When the market does drop, we do not want to panic and close out our existing options, the ones that we opened up when VIX is low. I have IBKR puts on my account. And if you look at the year to date, you can see IBKR was around $75 and boom, it went all the way down to $63.69. And now it's back up to $81.71 at its peak. If you take a look at our wheel here and you take a look at IBKR, we had these $70 put options already open in our account. We made money on them. Why? Because we didn't close them. If we did close them at its bottom, we were down like $600. And if you close that, you can see we've only collected $1,300. So if I close that, I lose half of my premium already. Another example is this. I have this example on our channel a lot. Take a look at the TSMCs. So I got assigned back in March of 2025. March of 2025 went from a peak of 220 all the way down to 146. Now it's back at 403.57. So just from the capital gains alone, I'm up 120%. And this is one of the reasons why if you are able to acquire great companies at great price points, when the market falls, taking advantage of fear, the upside is large. And that's hopefully what happens with Microsoft, which leads me to the third point. When these companies fall to great price points, the risk isn't getting assigned. The risk is not getting assigned. And so Microsoft right now, I may not be able to acquire 100 shares of Microsoft. So how do we mitigate against that risk about not getting assigned and having the stock run up? I like to take the credit that I collect from selling options and I like to buy the underlying equity. Similar to like dividend reinvestment, right? Dripping. I'll make a separate video about this, so let me know down in the comment section below if you guys want a deep dive into that strategy, and of course subscribe to be able to see that video. What I like to do in this case, especially when VIX spikes and the stock drops to a really, really good price, is I take all of the credit that I collected and I buy the stock. So take a look at Microsoft right here. And every single dollar here is using money that I've collected either from selling Microsoft options, NVIDIA options, IoT options, Netflix options. And from this, you can see the stocks that I've bought have already appreciated 13.4%. This helps mitigate against the risk of us not getting assigned. At least I have some stock, some equity to at least appreciate if I don't get assigned. We got to come up with a name for the strategy, so you guys let me know down in the comment section below what you think a good name for this is. Since dividend is called dripping, we want our equity to appreciate, especially in these very volatile and very quote unquote fairly priced zones. So let's just wrap this up. Number one, sell more options when VIX is high, be more conservative when VIX is low. Number two, do not buy back your options that are in the money because they'll ruin your P&L. And number three is you want to use your credit that you collected to buy the underlying equity, because in this case, when the stock market has dropped, it allows you to buy in and dollar cost average at a better price point so that you don't miss out on the equity appreciation if your option doesn't get assigned. If you have any questions, let me know in the comment section below. If you liked the video, make sure you guys like and subscribe to the channel. And if you guys want to try out Premium Insights, link is down below. If you guys want to watch the masterclass on how to sell puts and credit spreads, I'll link it at the end screen right here. And like always, until next time, peace.